Welcome to the first episode of the Wall Street Focus. Today, we are going to explore an important concept: why enterprise values stay neutral regardless of the capital structure. We will also looking at the relationship between the pre-money and the post-money valuations. Before we deep dive, let's start with some basics. What exactly is equity value? Think of it as the total worth of a company from the shareholder perspective, basically what the owners can claim as theirs. There is enterprise value, on the other hand, which represent what would it cost to acquire the entire business. Think of it as the all-in price tag. Now let's look at the relationship between the two values. You can see from the diagram that enterprise value equal equity value plus net debt. And remember, net debt is simply total debt minus cash and cash equivalents. And let me break this down with a practical example. Let's say company A is raising amount of 5 million with the dilution of 10% ownership. Now we have to find the equity value before the fundraise, which is called pre-money. We get this by taking the total amount raised divided by the percentage of dilutions minus the amount raised. This is the pre-money equity value. For the post-money, which is after fundraise, we can get this from pre-money plus the amount raised. Now, why do we say enterprise value is a capital structure neutral? Let's look at the components, starting with our pre-money scenario. Let's break down the enterprise value, right? We have equity value, total debt, and cash equivalent. And we have enterprise value. What is the equity value of the pre-money, which is 5 million, for the 5 million? And let's assume we have the total debt of 20 million and cash balance of 10 million. We get the enterprise value by taking the equity amount plus total debt minus cash and cash equivalent. Now let's look at the post money after the fundraise. We get the equity value from our previous calculations, which is 50 million, and total debt will remain the same, which is going to be 20 million, and the cash will be increased from 10 million to 15 million by adding up the cash balance plus the amount raised. Now let's calculate the enterprise value. Equity value plus net debt minus cash and cash equivalent. See that the enterprise value stay exactly the same even though our capital structure change, whether the company raises equity, takes on debt, or builds up cash. The enterprise value remain unchanged. That is why we call it capital structure neutral. I hope this helped clarify things.